Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. Got a lot to talk about today. So yeah, let's jump into that real quickly. But somebody out there, if you're watching, please let me know if you can hear me. I did have a little bit of trouble with my sound earlier today, but I want to jump right into it. All right, so I realize that on every financial page right now, on every news page right now, is not actually this news. It's actually the news of Queen Elizabeth passing away. And of course, Prince Charles is now King Charles. Anyway, I'm not going to cover that largely because I have zero interest in the British royal family. I realize that I have a lot of watchers from across the pond in the United Kingdom. Sorry, though, being raised an American, not interested in royalty. Anyway, so let's talk about this news right here. And I want to talk a little bit later about the European Central Bank. I don't know if they're coordinating actions, but they have actions that are very similar to the Fed. What is the Fed's ultimate aim with this talk right now? How the Feds talk and the words they choose are very carefully chosen. And what is some of the worldwide reaction and sort of the geopolitical scope of things going on right now? And we are going to take a look at some of the things going on on Reddit right now and talk a little bit about energy prices in Europe, the energy crisis there, how the Russia and Ukraine conflict is affecting things worldwide. Feel free to chime in with questions today. At the end of the live stream, I'll talk about individual stocks if you guys want to talk about that. Once again, nothing I say is a recommendation, buy, sell, or hold any individual security. So let's talk about this news today. Fed is on the path for another 75 basis point interest rate lift after Powell's inflation pledge. Now, I'm pretty sure that I'm on record at least a month, maybe a month and a half ago, talking about this, how I did not believe that this was the last 75 basis point interest rate hike. And then I believe that there was going to be another one and possibly a fourth one by the end of the year before they drop back down to maybe 50 basis points or 25 basis points, but probably 50 basis points. And it's getting to the point now where the old adage is true. Don't fight the Fed. Okay. And that's a little bit of what I think is happening right now. I think that the market kind of priced in those first two 75 basis point rises. Maybe they priced in a quarter point per quarter after that. What I don't think they're going to expect is that short-term interest rates may be over 4% by the end of the year. The Fed is freaking serious about inflation at this point. And they're using stronger language than they've used in the last 20 years or so. So what is the Fed's ultimate aim here? All right. So Powell keeps saying fighting inflation is going to bring some pain. What does pain mean? So officials also have done little to push back against market expectations of that third consecutive 70 point or 0.75 point rise. And they didn't do anything of the sort today. And I think that the market is responding. Investors in interest rate futures markets saw a roughly 75% probability on Wednesday that the Fed will raise interest rates by another 0.75% earlier this month, according to CME Group. I think that the stock market, this is a futures market rather, but the stock market is actually mispricing the Fed's intention here, and that we are probably going to see major stock indexes decline, even though major stock indexes closed higher on Wednesday, with the Nasdaq Composite ending a 7-session streak of declines. And that was Wednesday. Today, I haven't checked, but the last I looked, it was up a little bit by like 14 or 15 points. I haven't checked since the market closed, though. Oil prices fell to the lowest level since the beginning of the invasion of Ukraine. It was at $82 a barrel the last time I looked. All good news for inflation. Treasury yields also declined, with the benchmark 10-year Treasury yield closing at 3.2% from 3.39% Tuesday. This is actually still well below historical norms. A lot of folks that watch my channel, they really only pay attention to the stock market. But one of the better indications of how the economy is doing as a whole is actually the bond market or fixed income markets. And we are not even close to having a normalized interest rate environment. So based on a couple of suggestions from folks on my Patreon and people that have commented on my videos here, I did go back and listen to some of the past episodes of the All In podcast featuring, Chamath Palihapitiya and a couple of other talking heads on there. I will say that I enjoyed that. Not because I agreed with everything they said, not because they were there confirming all of my biases or confirming the opinions that I had, but largely because they were challenging some of the preconceptions and challenging some of the opinions that I had, particularly on government subsidies with solar and EVs. We'll get into that later, but also in terms of what we have in terms of an interest rate environment, what we have in terms of Fed intervention in the market. And I think Chamath Palihapitiya's main message there is that we have severe market distortion in fixed income. We have severe market distortion in the stock markets. We have severe market distortion in real estate markets. And it is going to take us time to find equilibrium, to find the true value of all of these assets, right? So Nelly Furtada says, I've never owned bonds. I'm 27 years old. Should I be considering them? So you should definitely be interested in bonds at this point. I don't know. And look, if you use any sort of what's called modern portfolio theory, portfolio construction software, anything like that, it's going to suggest, of course, that at least a portion of your portfolio be bonds. Even at 27 years old, if you're a super aggressive investor, they're going to probably recommend that at least 10% of your portfolio be in bonds. I basically have never held any of my portfolio in bonds, even though I had a huge book of fixed income that I traded when I worked for a regional bank, a couple $100 million a month that we were rolling in short-term fixed income, a couple $100 million a month that we're rolling in longer-term fixed income throughout the year. And this is despite all of this, I never had it in my investment portfolio because I just had a much longer-term view and was not scared of volatility and not scared of, when I talk about buying a stock right now, I also don't use a lot of technical analysis because my time horizon is so long that the technical analysis is not going to matter. I'm not going to trade it on a short-term basis. And I have news for you folks. And I commented on somebody made a nasty comment on another YouTuber's channel. And if you guys looked at my channel the other day, I did post something about Meet Kevin, and I mentioned the fact that I almost never watch other YouTubers. I did the other day. I went out and I sort of like looked at some of the guys that I watched in the past and some of the guys that I kind of admire. And I had no idea what was going on with Meet Kevin, by the way. And I think a lot of the criticism is probably unwarranted. And it's a lot of people just sort of like piling on, trying to get views and things like that. I'm probably not going to do that. And I think, Nelly, you're one of the ones who asked if I was going to do reaction videos. The answer to that is probably no. I don't like piling on other people's misery. I'll be, if you ask me a question directly, I'll be perfectly honest with you. But a lot of the discussion on one of Tom Nash's videos was, why doesn't he talk about technical analysis? And he stated on there that he doesn't know anything about it. And they were like, well, if you've been a financial analyst for 10 years, why don't you know anything about technical analysis? Well, the answer to that is very simple. There isn't a lot of evidence that suggests that technical analysis works over the long term. There's maybe 2 papers that suggest that it adds alpha to your investment portfolio, meaning that based on a risk-adjusted return, you might be getting a slightly higher return. And they're looking at some of the best professional investors in the world. But the vast majority of research tends to suggest that it provides no benefit whatsoever to a portfolio over the long term, meaning that you get confirmation bias when you think it works for you 2 or 3 times in a row, like you're buying when things move over or under a certain moving average. And pretty soon that you get confirmation bias by being successful 1 or 2 more times, not realizing that it's more chance than it is actually understanding patterns, not realizing that just because a stock behaved this way or the price of a stock behaved this way in the past, it doesn't matter. It doesn't mean that it's going to behave that way in the future. And it's not even likely that it's going to behave that way in the future based on what we know from the actual data that we're reading. So when we look at academic studies, and there's actually tons of academic studies on technical trading, very few of those studies actually suggest that it makes any impact whatsoever. So, Rad Shah says, no reaction videos, that adds zero benefit. but hey, you get more subscribers, but still not worth it. That's how most YouTubers grow their channels. I did notice that actually all of the financial YouTubers have fewer views on their videos. Like I said, I don't pay much attention to other financial YouTubers, largely because I didn't want to imitate their style. I do like Tom Nash's style. Don't get me wrong, and I do respect his intellect. I don't always agree with him, but I do respect his intellect and I respect his experience. He and I just have different experiences. So, but I will not be doing any of those. And I would love to have 250,000 subscribers and bring in, $10,000 a month in revenue. That's not happening for me, guys. I'm really doing this because I enjoy doing it. And I will continue to do this for as long as I enjoy it. And I've been doing it for 2 years straight. And right now my channel isn't growing for a variety of different reasons. I'm not putting as much time in as I used to, but I'm getting back on the horse here. And I'm going to be putting out some more instructional content, particularly with options tradings. So a couple of things you guys will never see from me is I'll probably never sell anything. Like I'm not going to write a book and say, go write my book or go buy my options course or something like that. I'm much more likely to just give it away for free. You probably won't see me. I get offers all the time for me to sponsor something or do a sponsorship video. Usually it's something that has nothing to do with my channel whatsoever, so I haven't even considered it. And the 3 or 4 different investment products or sort of investment products that I've taken a look at were pretty shady. And so I turned them down, even though the money was good, guys. The average offer that they start with is like, $20,000 and it goes up to like $50,000 pretty quickly. The money's pretty good. And I could definitely use the money like everyone can, but it's not going to happen just because I want to maintain sort of clarity. I want to see if I can make it just by speaking my mind and being honest and giving you guys my opinion, taking my lumps when I'm wrong and getting praise from you guys when I'm right. And I bet that I'm going to be wrong just as much as I'm right. You should all be doing your own research and making your own decisions here. So back to what the Fed is doing right now. Let's talk about what's going on in Europe, because this is important as well, because inflation is a global concern. And so when I was watching that All In podcast that was suggested by people that watch my live stream here, it was a lot more political than I thought it would be. There was one guy in particular that seems to be pushing a particular narrative who wants to call everything going on right now the fault of government spending, when and really too, he puts the blame on Congress and this administration, when really that idea is ridiculous when you look at inflation in a global perspective. It is supply shock. And the fact that the man could miss this was really telling towards me, because the last 7 or 8 inflation spikes that we've had where inflation went double digits or close to double digits, or it was there for a long time, it was all related to supply shock, right? And he didn't even acknowledge that in there, that typically this is what I don't actually care. I'll get to that David Sachs guy, but I don't actually care what side of the aisle he's on. I just want him to acknowledge facts. So, and he kept complaining about how the mainstream media doesn't cover this and doesn't cover that. And there is a narrative in the mainstream media that is being missed with inflation. It was a mistake to call it transitory. Even I called it transitory, even though when you look at past historical inflation events that were supply shocks, a lot of times the supply chain, because there's money involved, more businesses stepped in and that supply chain was normalized. This time the shock was worldwide. It wasn't simply limited to the United States and Europe or the United States and Korea or something like that. It was a worldwide shock. And there were a couple of underlying changes in, But so I wanted to acknowledge, so Dan sees your Shadim. All right. Okay. Great show. Thank you. My second time here. Well, thank you so much. I hope you've subscribed. And if you haven't, please do so. And David Sachs, he's Republican. Like, you guys know that I don't get tremendously political on this channel, although it's been hard not to be political just because of everything that's going on right now. And I haven't even talked about what's really going on with the Justice Department and the FBI right now, largely because it's irrelevant to So he's quite partisan. His worldview is informed by his politics. In Ratchets, I do appreciate David's opinions to help me expand my views. That's a really good point, because later on, even though that sort of, I didn't like that, he made a number of other comments in that episode that actually did expand my views. Part of it was on what markets are doing right now. Part of it is how the media has not been honest about economic reporting. Part of it is how the administration should have come out and said, hey, we have inflation right now. This is what causes it. This is how it gets resolved. And then that's sort of, they just, no one was really honest about what was going on right now. There was just, and there's a lot of water carrying in the media for different political parties. So he did point that out. And he also pointed out some very interesting things about solar and EVs that we'll get to. So, but I actually did enjoy it. I really respect Chamath Palihapitiya's opinion on a lot of things. I know a lot of younger investors were sort of disappointed by the fact that a number of his SPACs declined in value over the last year and a half or so. But you really have to understand the way he works as an investor. And he made some really important points in that same episode about synthetic biology as well that we need to cover on my channel as well at some point, because I talk about synthetic biology and genomics and all that stuff a lot. I think that I have a better way to explain the risks to you guys now that I've listened to Chamath Palihapitiya talk about it. Even though I understood them, I didn't have a way to express those to you in a manner. And that's a lot of my issues, is I don't know how to talk to people other than through this. So yeah. Chamath has a whole research team behind him, and he openly states he employs very good people. And he does employ very good people, and you should have an entire research team behind you. I'm lucky to have a lot of friends involved in a lot of industries who don't mind terribly when I bother them about professional questions, as long as I supply the beer. So this is the big news coming out of the European Central Bank. European Central Banks lifts interest rates again, keeping pace with the Fed. The European Central Bank produced an oversized interest rate hike on Thursday as it tries to keep pace with the Federal Reserve. Why do they want to do that? They don't want U.S. securities to become so much more attractive than European securities that we start attracting all the investment. And part of that is happening anyway because of the strengthening of the dollar and the weakening of the euro, which the weakening of the euro does not help them when it comes to inflation, right? So economists at Morgan Stanley basically predicted that inflation was going to be at about 9.1%, which is unbearable for the ECB president. And remember, the Europeans, for a large part of the blame that Europeans think is responsible for the emergence of Hitler and World War II, they believe that it was the inflation that the Weimar Republic suffered in the 1920s and 30s, and that was one of the largest things that caused him to rise to power, or for fascism in general to rise to power. Their concern with inflation is actually a lot higher with ours. It's much higher on the list of concerns for them when it comes to doing things globally. So I expect them to react fairly aggressively to this now that they're doing so. They just had a hard time doing it because of everything going on geopolitically right now. So what is the goal for raising interest rates? Let's talk about what the goal is for raising interest rates. So why the Fed wants to see a strong dollar and falling stock prices, right? This is what they want, right? But the falling stock prices is not exactly what they want. They don't actually care about the stock market, although they would like to see some of the value in the stock market unwind or evaporate, which causes that money to disappear from the system. But what they really want is more unemployment, a strong dollar, and falling asset prices across the board. That's what it's going to take in order to control inflation. And they have committed themselves to a path that will result in higher unemployment than we have today. You are going to know friends and family who lose their jobs, friends and family who blame politics for it, when it's really the actions of the Fed trying to, and they are supposed to be politically neutral, but they're not. There was even accounts of a closed-door meeting with Paul Volcker and President Reagan back in the 80s, where President Reagan was imploring him not to raise interest rates through the 1982 election, midterms or something like that. Anyway, they're not completely immune from politics. And I really think that in 2018, Jay Powell caved to political pressure, and basically it was fiscal policy, not monetary policy, that kept us from going into a recession back then. I mean, fiscal policy meaning the government started spending butt tons of money. If you look at the deficit in 2019, the year before the COVID started, we actually had the largest deficit on record. So we had the highest deficit spending on records, and we increased government spending by a huge amount, spending almost $1 trillion a year on the military at that point. And that was all sort of in the face of the government raising interest rates in 2018 in order to quell some concerns there. I think that should have been the natural end of that particular credit cycle. Now, Chamath in that All In podcast made a lot of points, is that we have not had a normal credit cycle since before the Great Recession, 2008, 2009. It's been 14 years that we've had a very accommodative Fed policy. It's been 14 years that we have not had natural floating interest rates in fixed income or in real estate loans. It's caused asset pricing distortion, and we don't know what the true value of many of these assets are going forward. It's going to take time to figure that out, and I think most importantly to us regular people, it's going to take pain. It's going to take a lot of pain, and that's what I find really concerning. So the goal of the Fed is a strong dollar. The goal of the Fed, which makes our ability to sell, which is sad, it makes our ability to sell products to our neighbors. Basically, it makes it harder, and they're going to be more expensive. It makes their purchasing power weaker. It makes our purchasing power for foreign goods better. That's unfortunate. But the other thing they want is unemployment, so fewer people can buy, as much stuff, and they also want asset prices to fall across the board. They're not saying this is that they want a soft landing. Soft landings don't really occur in Radcha. I'm getting to this right here. I'm getting to this right here. And it goes beyond that. I think, I don't know if you're paying attention, or are you aware how much energy bills have gone up, that they have to cap those energy bills. And we'll talk about that here in just a minute. In fact, we can actually get to that right now. Okay. So I went out to Reddit really just to take a look at what's going on out there. And basically all I did was put in electricity costs in Europe. So Germany already has the highest electricity costs in Europe before Russia, Ukraine, and they got 49% from renewables. Now their electricity costs are unaffordable. Does this mean windmill technology isn't good enough? Can they go 100% renewable? Are they pissed that the CIA? Okay. All right. I'm not gonna deal with conspiracy theories. I worked with really large groups of people for a really long time, and I realized why conspiracy theories are never true. And it's that 1% that convinces people that they're true, the 1% truth that convinces people that they're true. So why, and everyone's concerned about this right now. And hold on, I don't want to follow anybody. How do I get off of this? Okay, I'll just follow them. Does this get rid of this? Anyway. Oh, man. All right, so we'll talk about in our economics as well, called the dismal science. Let's talk about some of the news here. And there we go. All right, so this is probably the most important graphic that you're going to see vis-a-vis electricity prices in Europe right now and how it's affecting inflation all around. But look at this. This is year-over-year change in day-ahead electricity price, August 1st, 2021 to August 1st, 2022. Now, I'm colorblind, but even I can tell that the differences in shading mean that France is, their electricity prices are 500% higher than they were last year. Germany, Belgium, Netherlands, Switzerland, Austria, the Czech Republic, Slovakia, 400 to 500% higher than they were last year. And this is where I get to not being able to tell the difference between colors, but it looks like Hungary, Romania, Serbia, Croatia, Italy, those are all 200 to 300 or 400% higher. And it looks like Poland, Bulgaria, Greece, Finland, and Norway are 200 to 300% higher. And Sweden is about 100% higher, 100 to 200% higher. And Spain is 0 to 100% higher. So inflation and energy crisis affecting everyone across the board. It's pushing inflation up really, really high all over. And it was high to begin with, But let's take a look at these numbers. I'm not even sure you can see these, but we're going to talk about this. So the people that are blaming Congress for spending money here in the US or blaming the administration for how it's BS, man. And I can't tell you how much is BS. It doesn't matter how much the United States spends. It's not going to cause Estonia to have 23% on 23% inflation, Latvia to have 21%, Lithuania to have 21%, Czech Republic to have 17%, Bulgaria to have 14.9%, Hungary to have 14.7%, Poland to have 14.2%, Romania to have 13%. Let's move down to some more Western European countries. Netherlands 11.6, Greece 11.3, Spain 10.7. Belgium 10.4, Ireland 9.6, Denmark 9.6, Austria 9.4, Portugal 9.4, Germany 8.5, Italy 8.4, Sweden 8.3, France at 6.8, and Malta at 6.8. The only countries that are not experiencing abnormal inflation right now are Switzerland and Liechtenstein. And why is that? That is because of their banking laws and the fact that they have money coming in from all over the world right now because they're viewed as a safe haven. Liechtenstein's a little bit different, but at least Switzerland in that case. Liechtenstein still has some of those rules, but they're a really tiny country. They're really just a banking country. That's really all they are. But these are giant concerns that are worldwide. They're not limited to the United States. It's not caused by the United States. This is a worldwide economic disruption. I can't pound on that enough why that is. And people still want to view this through the lens of politics. And they want to view this through the lens of politics, which I don't understand. I guess if you're a rational person, you can never understand irrational people. And it doesn't matter. The next time we change administrations, everything's going to be blamed on the next administration, no matter how much it is. So let me see here. How much quantitative tightening will the Fed carry out over what period, and what effect will this have apart from pain? So I think it's going to be a long-term drag on the economy. I think that we should return our expectations to a good year, a good economic expansion of the economy should be around 2 to 3%. That's what we should be expecting, right? This close to 4.5%, 5% that we've had in years past, I think that's an indication that we've been overheated. I think that was the viewing how we measure that should be looked at quite a bit differently. We should go back to more of a early 1990s vision of how interest rates are supposed to work, what economic expansion was supposed to look like, and what a recession was supposed to look like. I think that was a more normalized time period. So when I talk about quantitative tightening, I don't think the Fed should have anything on the balance sheet. Now, that's just my opinion, right? But they've got roughly $9 to $10 trillion on their balance sheet right now at a runoff rate of $120 billion per month. How long is it going to take the Fed to take that money out of the economy? And by running off the balance sheet, that means they're getting paid back that principal. Now, it's not going to be that full 10 or $11 trillion, of course, because of how how yield to maturity works and the actual principal that you get back for that. But it's still going to be in the range of, say, $9 trillion. What is the Fed going to do with $9 trillion in cash on their balance sheet? What should the Fed do with $9 trillion of cash on the balance sheet if they're going to run it out over $120 billion a month? I know what I would do. I would burn it. Literally burn it. Literally take it out of circulation if it was physical dollars, or delete those electronic entries if it was physical dollars. Because one thing will never happen. We will never have a government that does not run out of deficit, right? I am not in favor of the Fed carrying a balance sheet long term. I think it's bad for the economy, and it actually limits their options going into the future. I think that some of this debt needs to be retired and doesn't need to come back. I think that some of this money needs to be taken out of circulation. And I think the Fed needs to aggressively do that. Even if they halt raising interest rates, even if they reverse course and lower interest rates at some point in the future, I honestly believe that they should continue on the quantitative tightening side with the runoff of the balance sheet, and they should eventually have nothing on their balance sheet. So, yeah. That is my opinion. It's not everyone's opinion, of course. So anyway, buddy of mine is sending me a text right now trying to get me to go out fishing, and we're about to start having hurricane weather here in Southern California. So no, thank you. Interesting news right now. Brussels presents a plan to deal with rising electricity and gas costs in Europe. The cost of 1 megawatt hour of electricity as of 23rd of August, natural gas, which is used to generate electricity heat, now costs 10 times more than it did a year ago. Natural gas is, of course, also used to make fertilizer, etc. And let's take a look at the cost of 1 megawatt hour of electricity in Europe as of the 23rd of August. So you're looking at 324 euros in Norway, 391 in Sweden, 600 euros in Germany, 611 in France. I can barely read that. It looks like 500 in Ireland. It looks like 636 in the UK. Still at 182 in Spain. Spain coincidentally made a massive investment in solar that didn't pay off for the individual investors, but it looks like it may be paying off for their grid. So Italy is at 605 euros per megawatt hour. And these are prices. So in the United States, we've essentially seen natural gas increase by about 60% over the last year or so. That's had a negligible impact on electricity prices here. They've barely risen here because markets are local, right? The natural. We talked about this before on my channel. We don't really ship natural gas, and we don't ship natural gas across borders as much as we do oil. The oil market is really globalized. The natural gas market is highly regionalized or even localized in a lot of respects. So, that's one of the things going out there. So we have a huge ability to take advantage of this crisis as natural gas producers to really make a large investment in liquid natural gas carriers. Europe has the capacity to receive all of the liquid natural gas that we can export. What we lack right now is the fleet to turn our liquid natural gas supplies into a floating pipeline. We lack the ships basically to supply them. The good news is that what is under construction right now represents 38% of the current fleet. There's, I think, 641 liquid natural gas carriers are worldwide. Only 14 of those being those QMax carriers, which are the largest ones that are really commercially available, and the rest of them are somewhat smaller. The rest of them can carry between 100 to 150,000 cubic meters of liquid natural gas. The conversion for that is like 1 to 609. So 1 cubic meter equals 609 meters in its vapor form that's used, right? So, and I did the calculations on another live stream where I determined that right now they need like 131 out of 641 ships worldwide to supply Europe with all of their gas needs. Their ports can accept it. It's that you can't divert that much of the fleet to Europe just to serve Europe, right? So it's going to be a cold winter, and next winter is probably going to be cold too. Beyond that, a lot of these ships are going to be, a lot of that 38% of the existing fleet that is under construction right now, with this one Korean company taking like 80 to 85% of the market share. And I imagine that shipbuilders in the U.S. are going to jump into that market now as well. I say that liquid natural gas has liquid natural gas carriers, liquid natural gas exports has a generational future in the United States. It may be a generation where this is an investment that pays off. We talked about Cheniere Energy. We talked about Total and a couple of other companies there in that live stream, how those represent opportunities for long-term steady gains, I think. So right now, the government of Ireland is preparing the country for electric shortages, warm public spaces, and surging fuel costs. Accuracy shock in Europe at 600 euros, the cost of electricity in France. I'm getting a lot of comments on my live streams from people in the UK talking to me about how expensive it is in Europe. And this didn't come as a surprise to me after hearing some of those comments. So also, European countries started to set caps on energy bills. They will have to cover the difference. If spending more money equals higher inflation, they have to increase interest rates to control inflation. Yes. It sounds like Maersk might be a good investment in anticipation of rising demand. So a couple of other things. So now, if they're going to produce that many more ships, we have a labor crisis. The merchant marine academies are not producing enough qualified sailors and qualified officers to man all of those ships. In fact, if you are looking to change careers and you don't mind traveling all the time and you like making, over 100,000 euros a year, $100,000 a year, going to the Merchant Marine Academy might sound like a really good idea. I think that's a multi-year investment that might do very, very well for your own future. Maersk, I don't know the degree that they're involved. They do a lot of dry bulk shipping. I don't know to the degree that they're involved in liquid natural gas. They do a lot of oil and dry bulk shipping. I don't know about liquid natural gas. So I would actually encourage you to research the companies that are really involved and own. And then a lot of these aren't publicly held. The companies that run liquid natural gas shipping. So, hi, Jason said, hope you're well. Do you see an end to the inflation issue? I don't see an end right away. I think that coordinated action between the European Central Bank and look, there are countries that aren't going to cooperate like this. Turkey is actually convinced that the rates that the central bank lends at has nothing to do with inflation. The Erdogan actually started this in I think 2018 or 2019, and he actually caused massive inflation before that. Eric M., that thesis is wrong. So partially, there's actually been a lot of work that's been done on this. It's a convenient experience. It's a convenient explanation. It certainly contributed to asset price distortion. Inflation, not so much. This is almost entirely supply related. So and I think that's what we're not going to know until a few years from now, when everyone goes out and all the economists, the dismal science, the economists actually go out and look at this in retrospect. But that's never been the case in the past. That it's really been a result of government spending. It's almost always been a supply thing. So, So here we go. Back to this. Do I see an end inflation? So I see an end by next year to the double-digit inflation that we have, or even the high single-digit inflation. But I see moderately persistent inflation in the 4 to 5% range for quite some time, for a number of years, unless we're willing to pay the price in terms of unemployment. So there's an economist, and I can't remember his name right now, but I was reading this like 3 months ago, and he was one of the earliest to sound the alarm. He said, look, there's a couple of ways we can deal with this. We can deal with 18 months of 10% employment, and then we crush inflation and we go back to 3% growth after that. Or we can have 2 years of 7.5% unemployment, and we can crush inflation and go back to 3% growth. Or we can have 5 years of 5% unemployment. And I think that's kind of where the Fed wants to land, is 5 years of 5% unemployment. 5% unemployment would essentially be lower than the 70s, 80s, and 90s, right? When 70s, we didn't have a normal economy, but mid 80s to mid 90s, we had a relatively stable and normal economy, right? That wasn't really affected by these tons of asset price distortions, where we had higher interest rates than we have today, and we still had nominal growth in the 3% range. And I think that's kind of where we need to get back to. And we don't get back there without pain. We don't get back there without unemployment. We don't get back there without tightening our belts. Period. It will not happen. There's no one's going to wave some freaking magical wand. You're not going to, the one thing we learned from the 2008 crisis is that austerity doesn't work either. All that does is deepen your crisis. It didn't work for Portugal, Ireland, Spain, Greece, and I don't know who else was in that group there. Italy was in that group. It didn't work for them. And ultimately, after having their economy crushed for more than a decade, having basically not necessarily a recession, but a stagnant economy for a decade, they ultimately had to turn the spigot back on in terms of government spending, just to get their economies to grow again. So that's not a policy that we're likely to pursue, simply because we saw the results of that. Austerity doesn't necessarily work either. So threading this narrow path to success, right? This basically threading a needle after running a marathon is what I think that the Fed is trying to do right now. But I think aiming for that 5% over 5 years, unemployment is realistic. I would be comfortable with it. The economy still grows, but it's in that normal 2 to 3% range. I don't think it's likely to happen because of how out of whack the Fed allowed the economy to get to begin with. David Sachs did make some very good points that quantitative easing should have ended a long time before it did. Like, there was no reason why that all the way back in April, the Fed should have been buying securities at that point. Buying the security, the Fed's been buying securities since 2008. They haven't stopped buying securities. They've got a balance sheet in the $9 to $11 trillion range. I haven't looked at it lately. They should not have a balance sheet at all, or at least a very small one. Even if they let all those assets roll off, what are they going to do with that $9 or $10 trillion of liquidity sitting in bank accounts? What are they going to do with that, right? I told you my opinion. It's a controversial one. No one likes it. It's actually not one that worked earlier. So, did work for Germany. Yeah, but Germany didn't have the massive debt issues that Greece did. I mean, I think Greece's GDP to debt ratio was like 206% or something ridiculous like that, and Germany's was like 106%. Very different, and or at the time, I don't know what it is now. I think Japan would probably be the highest right now. Like, their GDP to debt ratio is like 160, 165 in that range, and unlike the United States, they're not seeing a great deal of inflation right now. They've also endeavored, because they don't have their own gas supplies. They don't have their own oil supplies or anything. That they've endeavored for a very long time to use as much energy from other sources as they possibly can. You see a lot of ugly wind power there. They haven't. In fact, my wife went this summer. She went to so Tsukiji, the original giant fish market in Tokyo, has been moved to a new location. They built a new location. They have this massive solar farm there. But remember, it's a giant fish market, right? It's the second largest fish market in the world. There's one in Spain that's larger. And the one in Spain is like twice as large. It's ridiculous. But so their refrigeration needs and freezer needs are just incredible. Their giant solar farm there that only provides 2% of their energy needs, right? And that's for that fish market. But they are rapidly investing also in hydrogen technology, which is a bet that the rest of the world is not taking. Now, I actually don't know where. I heard this from Mr. Global on TikTok. And I don't know if you guys know who Mr. Global is, but like, I know his real name. I don't know that he wants me to say it, but he's a globally respected expert on the oil and gas industry. And he is making a bet that, and this is a bet that I am not making for a variety of different reasons, but I've talked about this on the channel before, but he's betting that because the choice to go to alternative energy sources is actually at its core consumer driven. And I think that's really evidenced by how popular solar and electric vehicles are now, that if it is consumer driven, he thinks that hydrogen is going to be the way to go. Why wouldn't you want to go to a hydrogen refueling station and fuel your car in 5 minutes rather than waiting 45 minutes to go from 15% charge to 80% charge for your electric vehicle? And he thinks that eventually that may be the sole reason, because it's consumer driven, that it wins. Now, I don't know if he's considered how much new infrastructure you need to build in order to have hydrogen refueling stations. You can't do hydrogen pipelines. You can't move, you can't move hydrogen like you can move crude oil. You can't move hydrogen like you can move natural gas. I mean, a renewable natural gas future, I don't know how we'd produce this renewable natural gas. Don't get me wrong. I don't know how we do that. But in terms of infrastructure cost, that would be a lot less than trying to recreate brand new infrastructure where we have to have massive liquefaction compression facilities, in which, by the way, you lose efficiency every time you do that. But he also made the point that, of course, that a hydrogen fuel cell vehicle is actually still an electric vehicle. That hydrogen fuel cell is a generator for a battery, right? So I don't have a problem with that. And I don't have a problem with the fact that the waste products generally are water vapor, right? And that's it. Cracking the hydrogen, though, is not a carbon-free process unless you use all solar. So we need a massive investment in solar, a massive investment in liquefaction and compression facilities. And we need trucking to take this everywhere, because we're not going to be able to do it with pipelines. So that is really, really interesting. So Eric M says Spain is disconnected from EU grid and gets natural gas from Africa, so they're unscathed. Well, I don't know about unscathed, but because prices are up there, they're just up there under that 100% mark. I wasn't aware that they got all of their natural gas from Russia, from Africa. I'd have to take a look at that, but I think that the age of European dependence on Russian natural gas, if Putin was deposed tomorrow and they suddenly said, "Oh, we're sorry, now can we sell you gas again?" That is not going to happen. There will be no resurgence of dependence on Russian natural gas. What I expect is that we may see more dependence in the future on Ukrainian natural gas, more dependence on the natural gas fields off the coast of Cyprus and Israel, more dependent on natural gas from Tunisia, Algeria, exploiting new natural gas assets in Morocco, in Zahra, if they can ever figure out the political angles from that. So I don't know what the plan would be to do that. Just look at H2 is the molecule for hydrogen. It's the second smallest. It is the smallest molecule you can make. It's H2. Hydrogen is the smallest atom in the universe. H2 would be the smallest molecule that we know of in the universe, unless there's another element that we don't know about that's even smaller than that. At this point right now, I cannot identify a gas pipeline technology that would work. I could definitely be wrong on that. And it doesn't mean that we won't find a way to innovate something like that. But at this point right now, I'm not aware of anything like that exists. So the complexity of the hydrogen car is ridiculous at the cost of the pump is just as high. So no, hydrogen would have been a better choice than gasoline. Gasoline at best is about 15%, and this is at best, is about 15% efficient from well to wheel. Hydrogen is about 25% at best, of course, efficient from well to wheel. More efficient if you've already sunken the cost of solar to crack hydrogen. It becomes more efficient, and there's no way to sink that cost for oil, right? And you don't have this continuous energy production in order to create oil. So this is what you can do. You can create it, and you can solve a couple of different issues with hydrogen as well. Like, it may be that we do this in combination. We basically take seawater, we mine it for minerals, including lithium, since a vast majority of the world's lithium supply is in ocean water bound up in lithium salt forms. And we use solar energy to desalinate, to mine for lithium, and to crack water for hydrogen. I think that's in the future at some point. I don't know how that happens though. And a lot like, and this is an idea that's in its infancy. I'm sure I'm not the only one that has this sort of combined use facility in mind. And this is an idea that it's so in its infancy, it's probably going to end up being like that first generation of synthetic biology companies, where the ideas were great, the story was great, but the execution wasn't there, and so it failed. So it's going to take a second generation of that. So yes. So Michael Will says a liter of petrol is about €1.68. So that's a lot of money in dollars. It's over $6, $7 a gallon at this point. So actually, hold on, my math is correct. Yes, over almost $7 a gallon. But that's in terms of trying to European prices for petrol have always been higher than the United States, much higher. So yes. So currently the fuel duty in the UK is 52.95 pence per liter. Any government would want hydrogen so they can tax it. Oh, so here's the thing. It's not inconceivable that you can create your own hydrogen and the government won't know anything about it. It's technically enormously complex, just like putting together your own computer would have been in the 1980s, or putting together your own solar farm in the 1970s. It's technically complex. But as more and more people get into that, it's going to become cheaper and less complex. I can put together a an essentially infinitely running solar system right now using only the knowledge that I have in my head, because other people have done all that research for me. I've read all about it. I've watched videos on it. I actually put together a solar powered kayak almost 20 years ago at this point. I had a solar powered bait tank for my kayak, literally because I was just too lazy to take the battery out of my kayak and recharge it every time and have it ready to use every time. I created the solar powered bait tank, and there are a few people in La Jolla, California that may remember that. It worked flawlessly for about 4 years. So yeah, and until I ended up, I started making longer trips, so I got rid of the solar panel just because it was creating too much wind resistance. And but yeah, that's so. Yeah, so initially they'd be able to tax that, of course. But when people produce their own, literally, you just need water to produce hydrogen. And eventually a home development kit would arise where you could produce some of your own hydrogen using the solar on your house. I produce way more energy than I need right now. Although, guys, that's coming to an end because of all of the driving that we're doing right now. I think I've told you guys, every time I've had the opportunity to buy an electric car, I ended up buying stock in Tesla instead. Finally, that may be changing. Number one, I need a new tow vehicle for my boat. The vehicle that I had right now, earmarked as a tow vehicle, never got repaired. I wanted to use my boat this summer, really didn't get a chance to do it. And we also need, because we're doing a lot of driving now, shuttling kids back and forth, we need a daily driver that's electric, especially when we could drive for free because we have freaking solar on our freaking roof. And that is what's going on. So I will be buying an electric vehicle. And right now, I have to be honest with you, because of my towing needs and because of my lifestyle, I'm leaning towards that Ford Lightning F-150. I'm going to go test drive one this weekend. I haven't even seen one on the road yet. I'm going to go test drive one this weekend. And I'm looking forward to letting you guys know how that works out. And by the way, guys, dealerships are really trying to rip people off right now. Make sure you check anywhere within a 50, 100-mile range of where you want to buy a vehicle. Like I changed my zip code a couple of times and was able to, just on their calculator, able to save like $6,000 or $7,000 on the price just by going an extra 25 miles away. So check that. So, I still haven't shown you pics of the boat. I'll actually share one of those pics today to my YouTube channel on the community. I'll only share it though if you guys promise to go and like the picture as a way to promote my channel. So Hal says approximately $4 US bucks a gallon in Australia. Well, that's cheaper than it is in California right now. Yeah, I think it was $4.85 the last time I filled up. Yes, $4.85 the last time I filled up. So let me see here. Taking a look at the dismal science here. And traders are hoarding gas at sea so they can cash in once prices surge over Europe's winter supply squeeze. This is a report. Doesn't surprise me at all. And they're talking about natural gas. Fed Chair Powell vows to raise interest rates to fight inflation until the job is done. This is the biggest indication that you absolutely should not be fighting the Fed at this point. And one of the strategies that you want to employ right now is a basic bearish strategy. I think that selling covered calls on the stocks that you have right now at a price at which you would be willing to part with them is a great way to generate extra income. I think that the market is likely to go down again once the market properly prices in the idea that interest rates are going up for quite some time. You're probably going to be able to pocket that premium without actually having to sell the stock, and you get to do it a few more times. Be very careful about how greedy you get, though. Make sure that you're using deltas. We've got to take a look at the Greeks every time you buy or sell options. Take a look at the Greeks. Make sure you're using deltas at least 0.7 or over. Even that's kind of risking it. I like 0.8 or over. I like these options to be anywhere from 30 to 45 days out there. I want to take advantage of theta, which is time decay, meaning that the option is going to drop in value just based on how close you're getting to that expiration date in a lot of cases. So a couple of things. I've actually sold a bunch of puts lately. out in the 60 to 90 day range at ridiculously low prices. And I'm actually getting pretty good premiums for that. Like I sold, I don't remember exactly what I got, but I sold Upstart puts at 12.5 for December and January. And between the two, I don't remember exactly how I might have bought. And this was just this morning. It was like over $1,000 in premium for a stock that I'd be happy to own at 12.5. This is a company that's been profitable for a very long time. This is a company that generates revenues. This is a company that has low expenses and is doing quite well. Yes. And happy to do that. I also did it in 2 other stocks where basically I sold puts at more than 50% below the current price, far out there, 60 to 90 days. And you're getting a lot of premium there because the level of fear is rising. I'm perfectly willing to buy Upstart at less than 50% of the price that it is today. I hope it doesn't go down because I already own some Upstart. But if it does, I'm happy to buy it at $12.50 a share. And I'm taking a lot less risk if it does. But even so, I just pocketed close to $1,000 or maybe it was over $1,000 in premium on that. What am I going to do with that premium? Well, right now I'm building a war chest. And I'll look to buy back some of my calls if a couple of them get really, really close to being executed. So I'm not spending the premium that I have right now. But let's say that, and my calls are shorter than the puts that I'm selling right now, right? So my puts are out 60 to 90 days. My calls are 30 to 45 days, right? So once my calls expire, what I'll probably end up doing is using the accumulated premium to sell more puts on something else. I'll use the cash that I've generated to generate more cash. Okay. And this is part of the wheel strategy that I use to constantly generate new income, to constantly generate new positions in stocks. So, and I'll get around to making videos on this one of these days. I've been really lazy about making videos lately. I really enjoy doing these live streams. But anyway, so also, I'm going to be doing some videos on UK retirement accounts and things like that as well. I've been doing a lot of research on those, and I'll be doing this. So we're coming up on the hour. Good information that I went over today. Reddit is not a great source for factual information. It really isn't, but it is a great source for sentiment on markets. And it's a tool that I find myself using more and more and more to really judge sentiment, which can be important to influencing how people buy and sell. Certainly, it's influencing their moods. So this is really interesting. Greece plans to repay Eurozone bailout loans early for the first time. Interesting. Quiet quitting. Quiet quitting is something we should definitely talk about at some point. I'm all for it. Not doing the bare minimum, but doing what you're paid to do and no more. And, if you worked in corporate culture, you hear that grind, or I heard that Kevin Leary guy talking about, if you put the computer down at 5, you're not going to work for us. I'm like, so you want me to work beyond what I'm paid for? Nope. Not going to do it. Not going to do it. So that is literally just an attitude that allows you to be exploited by basically your capitalist overlords. And I see this as a disgusting and dirty capitalist myself. And when I say capitalist, I mean, that's actually how I make my money. I take my money, I create new businesses, and I don't work in the business because I don't really like working. All right. And that's literally the definition of capitalism. If you go out and create yourself another job, meaning if I go out and open a restaurant and then I manage a restaurant, yes, you're an entrepreneur. You are not a capitalist. You just created yourself a job. That's what you did. It's and so the whole idea of the petit bourgeoisie, the entrepreneur, and the capitalist, they're all sort of conflated in people's minds, and they don't really understand the distinctions. And they don't really understand how the system works to influence people who are not really capitalist. So I'd love to discuss that with you some days. That's more of a weird philosophical discussion. So can you do a video on bond SMEs, corporate government, bond ETFs? So each one of those would actually be a separate video. I've done videos on junk bonds before, and they got like no views, like none. And I think my video on junk bonds, I had like 6 unsubscribes. This is a long time ago, like when I was under 1,000. Maybe that scared me off from doing videos on junk bonds. I actually, typically the only fixed income that I have owned in the last 20 years has been junk bonds. I've had very little government and very little corporate bonds. Although we will be entering an era where new issue bonds are going to be a great investment. Not right now, but relatively soon. New issue corporates, investment grade corporates, are going to have returns comparable to what stocks are. I think that's really in our future, and I'd love to talk about that. And but that's something that I'm talking to other professionals. Put it this way: people who trade fixed income, like bond traders, they can't even talk to each other. It's so boring. Okay, so I got to find a way to jazz those videos up. Right. So I tried talking to my kid about this the other day, and he's 12. He fell asleep. Anyway, that's how much of a nerd I am. We can just, Star Wars is our most common topic anyway. Although I will admit, I'm actually, well, I don't want to tell people what I'm a fan of because it's basically a religious thing at this point. Anyway, love to talk to you guys. If you have any more questions, fire them away right now in the next minute or so, because I am probably going to get off this live stream. It's been a great live stream. We had more people than normal. I think I'm going to cut back to this formula of doing 2 live streams a week. I did 4 a week for the longest period just because that was when the market was crashing and the market was going down. Right now, we've had kind of a more steady decline rather than the sort of like hijinks that we had earlier. But we're definitely in a calmer stage. I think people have accepted that Fed action is going to depress employment. It's going to depress asset prices across the board, including stocks. And it's going to strengthen the US dollar and weaken our export abilities for quite some time. I think the market is accepting that right now, and it's going to take a little while for that to get priced in. And if the market gets really bad again, I'll go back to doing daily live streams. But look at me not panicking here, right? I have a huge portion of my personal net worth in the stock market, most of it in ETF portfolio, but about 30% of it in individual stocks. Look at me not panicking. Why is that? Because my investment philosophy, time horizon, and goals go far beyond the next year or two. And no, I don't like losing money over a 1 year or 2 year basis, but over a 10-year basis, I'm going to do pretty well no matter what. There's actually very little chance based on the construction of my portfolio that over a 10-year basis that I will lose money. And if you manage your portfolio just with a 10-year time horizon period, and you're sufficiently diversified, you understand risk-adjusted return, there's actually very little chance that you will lose money over a decade or so. And we can talk about this. Another one of those subjects is like incredibly boring that people don't really like because they like the excitement, the Vegas style excitement of talking about individual stocks and making individual bets. Hey, I like talking about it too. But the reality is 70% of my investment portfolio is in index ETFs. Why? Because for a vast majority of stocks, all available public information will not lead you to a better investment outcome than simply investing in a big basket of stocks, right? And particularly, I think anything on the S&P 500, it's very hard to beat the overall market by trying to pick things out of the S&P 500. If you're going to buy individual stocks, I really think you should be buying like small caps and mid caps and betting on growth. Now, it's higher risk. Of course, you're going to have more losers than you are going to have winners, and you're only going to talk about your winners. So people are going to, that's the thing. Like I've got more losers in my portfolio over the last 25 years in small caps than I have winners, right? Did I hedge my position in SoFi with something else? What do you mean by hedging it? So I've been making money the whole time on it by selling call options. It has not equaled, of course, what I would lose if I sold this at this point. And I'm not happy with the fact that I've been adding, even though I said I wouldn't, I've been adding. So my average cost for SoFi is like $16. So I'm really in the hole when it comes to SoFi. But no, I haven't really hedged it other than selling options. And oddly enough, put options on SoFi have not increased in price so much like they have with Upstart. Probably because I think that 60 to 90 days is when people are starting to think about the end of the student loan moratorium and that their business will increase. So even if you look at somebody with $10,000 or $20,000 student debt, that is not SoFi's refinance target when it comes to student debt anyway. they're looking at professionals like doctors, lawyers, engineers who have $150,000 in student debt. Some of them make over that $125,000 amount. Some of them actually don't. You don't know that they do, especially doctors who are residents. They make like $60,000 a year. Nurses make more than them for the most part. And so that's actually a good question. I'll get to that in just a second. But I think that people see a bottom for SoFi around $5 a share, $4 a share, period. And when I look at selling puts, even out like into like June of next year, I'm not really getting a great price, right? In terms of what I'm risking, meaning the amount of purchasing power that I'm taking up by selling a longer term put, because that's what you're doing. When you sell a put, you're selling your purchasing power. You can't use that for something else, to buy something else. That's not the best deal right now. So I'm just selling calls that are way out of the money right now because I anticipate a run up in SoFi going into December and January as the moratorium expires. Also remember that even if you get $10,000 forgiven, even if you got $20,000 forgiven, in a lot of cases, there's still going to be $40,000 to $50,000 of debt out there that still needs to be refinanced. And SoFi is probably the place those people are going to go. And so, no, I haven't hedged on the bottom with anything else. I haven't made a bullish call at the bottom by selling a put at $4 or $5. And I haven't made a really bearish call by selling anything close to the money on SoFi when in terms of a covered call option. I'm selling things so far out of the money that I'm only generating a couple $100. Like I just sold, I did sell 42 calls on SoFi this morning, but they were at like $8.50 a share. And I think November 16th was the expiration, and it was only a couple $100. It wasn't that much in terms of a premium generated, and that's what I expect. I don't actually want to sell SoFi at that price. I just want to generate some premium. Olarinde Ajay says, do you own any agricultural themed ETFs in your portfolio? So no, I've thought about this, but honestly, the best bet for any agricultural themed ETF is to buy the fertilizer or potash producers. That is the best bet. Those are the people that benefit the most when new farmland comes under cultivation. Those are people that benefit the most when there's any threat to the food supply, and it's going to be those fertilizer and fertilizer precursor chemical makers. So potash producers and fertilizer makers. That's my bet on agriculture. I realize that there are a lot of farmland REITs that are coming out. I am really highly suspicious of long-term success of those farmland REITs. Farming is not the stable business that you might imagine. Farmers have years in a row where they lose money and don't make any money. Farmers have years in a row when they're wildly successful. The whole biblical adage of 7 fat years and 7 lean years. Hey, we may be seeing that with the economy, but that's nothing new with farmers. That's something they go through all the time. And trying to create a REIT, like a real estate investment trust around like agricultural land, I'm going to be really surprised if that survives a decade. And it would literally take me a decade before I would buy into one of those. I want to see that long of results before I buy into one of those. So I think one of the better ways to help you keep up with inflation right now is to buy apartment REITs. Apartments are going to be in much higher demand. Rents keep up with inflation. I do think that rents are a little bit inflated now. We might see rents come down a little bit. But man, I'm hearing stories. Yes. Archer Daniels, absolutely. Yeah. And I think they're a dividend aristocrat as well, that they've raised their dividend something like 25 years in a row. Yes, that is definitely something that I would take a look at. And let's see. And they're not a household name. And it's not, that is definitely not a household name, not something that everyone and their dog has heard about. Although they are a large company. Man, my internet connection is not cooperating. Hold on, let me get rid of some of these other screens right now that take up a lot of memory. Yeah, Archer Daniels Midland. So market cap of $50 billion. And I bet half the people listening to this have never heard of it. Low beta of 0.77, price earnings ratio of 14.24, earnings per share 6.3. Really healthy volume, average volume about 3 million shares. Volume is up for some reason, not really sure. Dividend of 1.83%. But this is a dividend growth company, guys. It's not about current dividend. It's the fact that they grow their dividend like 10 to 15% a year. So it's going to be, I mean, you could buy something that has a 5% dividend now they're not going to increase it for 5 years, or you can buy something for its 40 for this. So for its dividend growth. All right. So Archer Daniels Midland Company produces, stores, processes, merchandise, agricultural commodities such as products, ingredients in the United States, Switzerland, Cayman Islands, Brazil, Mexico, all over the world. So, and I can tell you what they mostly deal with is feed products, not for humans, but for animals. And that's what I know from experience where I grew up in rural Texas, that this is what they deal in. And there's a couple of other companies that are involved in that space. This would be a safe bet a safer bet. Nothing is safe. If it's equity at this point, it is not safe. Not that any equity should ever be considered safe. Any stock should ever be considered safe. You always have the risk of it going to zero. This one in particular, this is blue chip territory, guys. I think they are a dividend aristocrat. I'm not really sure. And if I look at the way this company has grown over the years, we've seen quite a bit of a spike since 2020, 2019, as we've seen interest in agricultural land increase. And part of that is, I don't know, not sure how much of that is justified, but if you look at the historical growth of this company, it's been pretty good with a couple of flat periods here from 97 to 2003. Yeah. So for interest, the Australian farm sector is near record levels. Demand for farm equipment is a record. Small company I know normally does 13,000 tractors per year, now at 18,000, and the year is not even finished. Yeah, well, knowing that a large portion of wheat and seed oils and corn is being taken off of the market right now has caused a lot of people to invest in, yeah. So a lot of people to invest in production. And here's the thing, it's like this, it's not like oil production where you get like massive oversupply because of government intervention in farming all over the world. Farmers tend to be insulated from bad choices or bad luck in a lot of cases. And it's, in order to be a really successful farmer in the United States, you actually have to be a really successful commodities trader as well, an options trader as well, which a lot of people don't realize. A lot of people don't realize that farmers in the United States, the big guys, I'm talking about, that have the huge family farms, and most farms are not factory farms like people call them. I don't know why. They're just giant family farms. Usually a couple kids have like master's degree in soil ecology. A couple of them have degrees in economics. They're usually a couple, kids in the family that are giant, big brain, commodities traders, and they're able to trade in futures as well. These are sophisticated operations, and yet still, because of the vagaries, uncertainties, and the capricious nature of Mother Nature, they are going to fail sometimes. But for national security reasons, we have chosen to support farming all over the world. Everyone does this, and I think that we should. So, Big Brain, we came out of the woodwork with some of these questions. Appreciate Access Your Brain. Thank you so much. And will you talk about marijuana stocks in the future? Yes and no. Marijuana stocks have a long way to go, and a lot of it has to do with the way that the law has to change. One of the big disappointments about California legalizing marijuana and Colorado legalizing marijuana is that we are not collecting the tax revenue that we thought we were going to collect. Yes, we're collecting butt tons of tax revenue, but it's not what we anticipated collecting, largely because a huge portion of that business is cash, and a huge portion of that business disappears. And there's very little way to stop that. I see it either they're going to normalize this business and bring it into the economic fold where you will be able to use credit cards They will be able to get regular bank accounts. They're not going to have to do all of these gyrations in order to satisfy all of the Patriot Act. Basically, it needs to be taken off. It needs to be descheduled. It needs to be taken off the Schedule 1 drugs, right? That's my opinion. We live in a democratic republic. We elect leaders that are supposed to reflect our values. And one of those values is that people in this country love to smoke weed, so it should be legal. Period. And just like alcohol is legal, period. It should be legal because everyone wants to do it. And we live in a democratic republic where we elect our leaders that reflect our values, supposedly. But until that happens, it makes every investment really, really chancy. And most of these first generation weed stocks are going to fail. One way or another, number one, you can invest in anything retail. And normally I wouldn't invest in a lot of things retail, but with marijuana, I would. But you can't invest in anything retail because they don't have access to financial markets. Investing in anything on the production side, you're looking at a lot of risk in terms of capital layout to create these built facilities. And you're looking at uncertain returns as retail is relatively uncertain. And also, here's the other thing. Because weed is legal in a lot of states right now, but it's not legal federally, the way weed is produced is going to change. Hydroponic weed developed because there was a need to hide weed cultivation. I think that the way that it is cultivated is going to change rapidly, and that could have a huge impact on lowering the cost of creating these growing facilities. We might start growing it outdoors again in large volumes. I don't know. So I think it's really early to invest in this. I've never owned a marijuana stock other than for a real short time. Where I was just kind of playing around with it. There's only a couple hundred shares of a stock that was worth under $1. But no, I probably won't be looking at buying a weed stock anytime soon. I won't be looking at investing in that industry and individual stocks. I may take a position in ETF at some point, but right now there aren't enough public companies to do that. So, all right, guys, I have to call it a day at this point. I have other things that I need to prepare for. Very happy to hear from you guys again. I will see you at a minimum by next Monday. Hopefully I get some videos out this weekend. Thank you very much for attending, and I'll see you next time.